Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Anton Ivanov. He is a U.S. Navy veteran, real estate investor, and entrepreneur with a 40-unit rental portfolio across 4 states. His portfolio generates over $20,000 in monthly passive income and requires less than 1 hour a week to manage. In addition, he's also the founder of 2 real estate software platforms, which we will get into today, RentCast and DealCheck. So thank you so much for coming on the show today, Anton.
Thank you for inviting me, Charles. Great to be here.
So please give us a little bit about your background, both personally and professionally, prior to getting involved with real estate investing and getting involved with and why you before getting involved with those 2 real estate platforms as well.
Sure. So I kind of going back probably 15, 20 years, I joined the U.S. Navy, active duty at an early age, pretty much right after high school. Did a little bit of college and then went straight there. At first, I would say when I was in my early 20s, real estate wasn't too much on my radar. I did get into personal finance, kind of investing, your IRA, 401k, like the basics that they always teach you, started budgeting, kind of building my personal finance situation, if you will. And then real estate wasn't on my radar until actually my parents passed away pretty suddenly at a young age. And they had a condo that they used to live in California. And I basically was stuck with that property, after their passing. So I was actually deployed in Japan. So I wasn't even living in the States at the time. I was in the Navy kind of doing my thing. All of a sudden I have this property. I'm like, oh man, what should I do with this? Should I sell it? Should I try to manage it? I really didn't have any experience, buying real estate, managing real estate. I kind of was familiar with it, obviously, but nothing in detail. So I was thrust into this a little bit, if you will. Ended up kind of talking to a few folks, my mentors, if you would, at the time, older people. They said, hey, why don't you just keep this property, at least for now? It's probably not going to be bringing in a lot of income because California is a tough rental market. But you can always, when you get out of the Navy or move back stateside, you can kind of reconsider what you do with this property, live in it or rent it out. And that's what I did. That's exactly kind of how my journey into real estate, or my real estate portfolio, if you will, started. I ended up keeping that property, renting it out. And over the next few years, it kind of trickled in a little bit of cash flow every month, nothing life-changing, but it did open up my eyes to what real estate can do as a passive investment vehicle, as a wealth generation vehicle, and kind of gave me, a little push to get into more of it down the line.
Yeah, I think every investor has that property that they make the decision, to quit real estate investing or to move forward with it. And that was, for me, my second property. And the first one was tougher. The second one, I kind of knew what I was doing a little bit more than the first one for sure. And that was like, okay, now I see like how this works. You know what I mean? And I see all the benefits with it. And you kind of see it from the whole thing from doing it before. And I think it's real powerful. So it's great that you had that so early on in your career.
Yeah, I think real estate is kind of a very hands-on, I would say, endeavor, or even career, if you want to make it that. It's I meet a lot of folks that they're like, hey, I want to get into real estate. How do I get started? I've read a million books, blogs, whatever, and it's really, owning, buying your first property, whether it's like a personal residence that maybe you rent out down the line, or if it's an actual property that you buy to rent, you get, maybe inherited it from your family, folks, parents, like what happened to me. I think you learn so much more doing, that first property, going through the buying purses, going through the renting, managing process, that you will learning a lot of books, magazines, whatever you want to read. It's a very hands-on investment. And I think once you get into it, do your first couple deals, you'll quickly both get the hang of it and realize like, hey, is this for me? Can I do this long term? Or maybe, I'm just not cut out for it, which is okay too, right?
Yeah, and you'll have, everybody knows people that have that person that has a horror story as a landlord and doesn't, and was going after a couple properties. Maybe we've purchased properties from people like that, but it's the education and The education piece I find different because the people that are writing books and are educating you for the most part, they're in a whole different stratosphere of real estate investing where you might be buying a C minus property, and they're giving you information and a guideline and a guidebook for buying B plus properties, newer build properties, larger properties, and they don't always mesh together. You know what I mean? They're in a whole different kind of ball game by the time you're getting in there. So it's kind of difficult to follow people that are that many years ahead of you, or that forget or don't really know or don't have those properties anymore that they started with. So it's doing it yourself, obviously, is the way that you're going to get a lot of scars. You're going to lose money and different things, but you're going to learn lessons. But as like I said, with my second property, it was cash flowing from the beginning. It was, it was set up much better than my first one, and I kept both of them. But it was something that you have to learn from doing.
Absolutely agree, 100%.
So before we kind of get into your the real estate software business, because I imagine that was brought in by you building out a real estate portfolio, let's talk about like kind of your current real estate portfolio and what is your real estate investment strategy? Obviously, you're not a full-time real estate investor; it's a part-time job investment for you. Let us know how that kind of looks for you.
Sure. So, yeah, I've always kind of looked at real estate as an investment strategy, not necessarily as a career strategy. And I think that there's no right or wrong way to go with real estate. For me, my wife, it has always been, we had our little IRA, our 401k, our equity portfolio, stocks, bonds, that sort of thing, kind of the more traditional investing. And then ever since that first property that we had as a rental, we also decided, hey, we want to have a real estate component because I think it's a very unique, kind of investment vehicle and strategy, not only to help you diversify from equities and other investments you may have, kind of add an additional asset class to your portfolio, but it also is pretty unique in the sense that it can help you build both your wealth and net worth, kind of your paper wealth, if you will, through property appreciation, loan pay down. But it can also start generating cash flow from day one, like you said, if it's a good investment. So it provides both cash flow appreciation, which you don't see a lot in kind of, for example, stocks. A lot of stocks and even growth focused index funds, they tend to appreciate in value, but then not necessarily provide you that cash flow. So if you kind of go through the first growth phase, you're typically focused on appreciation, that you'd have to reposition your portfolio to focus on cash flow. With real estate, you pretty much have both from the get-go, and you can obviously kind of skew your portfolio either way depending on your preferences, but I think it's kind of unique from that perspective. So so once myself, then my wife at the time, future wife, we moved back to the state side, we kind of decided, hey, we want to expand our real estate portfolio. I think our initial goal was something like on the order of 50 rental units that we wanted to have, 10, 15, 20 years down the line. And we kind of work backwards from like, hey, this is how much cash flow we think we need to retire or at least live comfortably on. What is the realistic cash flow that we could get per unit? And that kind of arrived us to about 50 units. That's kind of still our goal today. We're trucking along. We're at 40 right now, so not too far from 50. Hard to say where we go from there, but right now that's still a good goal. Now, in terms of kind of strategies, we've honestly did quite a few different ones. I'll touch on them briefly. So the first property I kind of described, our actual property that we bought ourselves was a duplex that we house hacked. If you're not familiar, house hacking, I think, is a great way to get started with investing, especially for like military folks or people who travel a lot, move around a lot. It's you basically buy a multifamily unit, live in one of the units, rent out the other unit or 2 units if it's a triplex, or 3 units if it's a quad. This allows you to take advantage of owner financing. You can put a lower down payment. You're there to oversee the property, but you're still collecting rental income. In fact, if it's a good, do a house hacking kind of duplex or triplex, sometimes you can get your rental income to pay for pretty much your mortgage, all of the expenses. So you're living, rent free. at a property with your tenants paying for everything. So we went from that. Then we did some turnkey investing out of state. The reason we kind of went that route is because we were in Southern California at the time. It's a very tough market to build a portfolio, especially 50 units. With the home prices there being so high, you need a lot of capital, a lot of money for down payments. If you're trying to buy 10 units in the next 10 years, we're talking millions probably of dollars of capital that you need. We decided, hey, this is probably not very realistic. We definitely won't get to 50 units. So we started looking out of state. And I kind of developed a market selection strategy where I focus on a lot more on linear, kind of your quieter markets. They tend to be a lot of Midwestern cities where they may not necessarily experience high growth spurs like your coastal cities, but at the same time, they're more stable. There's better rent to price ratios, meaning you're not paying hundreds of thousands of dollars in property value, but you're still getting very good rental returns. So we bought a few turnkey properties in Alabama and Georgia. And then more recently, kind of once we got more comfortable with out-of-state investing, we transitioned to just focusing on a single market. For us, that was Kansas City, Missouri. Again, I looked at a lot of macroeconomic factors affecting that city. It's not like a super sexy city, like it's not popping like Phoenix or Vegas was 10 years ago, but it's a very strong linear market, good job growth, good population growth, which I think are keys to kind of being a successful long-term rental investor, because you want to see the property values go up. You want to see the rents go up. You don't want to see them stagnant because over time, you're going to have inflation. You're going to have rising expenses. So you need the increased rental income to keep up with that, obviously build your cash flow. And at the same time, you do want property values to go up because that's a great component, as I mentioned, of real estate investing is that equity buildup. So Kansas City pretty much met all the criteria. We worked with a local team there. We built a team of property managers, maintenance crews, kind of insurance agents, brokers, that sort of thing. I actually flew out there several times kind of to meet with all the folks we've ended up working with. And over there, we started buying more multifamily property. Again, this came from our goal of 50 units. Buying 50 homes is a lot more work than buying, let's say just a handful of fourplexes or even a couple like 10-unit complexes. You can just get many more units in a single transaction. So you kind of kick in a little bit of economies of scale. So we stuck with multifamily, a lot of fourplexes there. It's kind of a great market for that. Not every city has, fourplexes in nice areas. Sometimes multifamily is kind of in not so nice areas that we tend to avoid. And yeah, we've been very successful with that. That's how we got to 40 units. We would look for usually off market, kind of value add multifamily properties, not complete tear downs. That's not our forte, but properties that are maybe dated, need some cosmetic work, maybe had an out of state landlord that just neglected them a little bit, hasn't been raising the rents, hasn't been keeping up with the property conditions. So we would pick them up. A lot of it is off market, so we can get a good discount on the property values. And then we will come in and over time rehab the units as the tenants move out, kind of update the appliances, the kitchen, the bathrooms. Usually, again, I would call this cosmetic work, and then we can raise the rents up more to the market values and start collecting increased cash flow, kind of build our equity again through some sweat equity, as it's called, when you're improving property condition. And yeah, so that's kind of the gist of where we are now. I would say for the next, at least 5-10 years, that's what will probably continue, is kind of, probably Kansas City, probably still multifamily. And in recent years, as kind of market conditions became a little more challenging, we haven't been buying as many properties. First, it was COVID, brought a lot of uncertainty. I wasn't actually sure what was going to happen with the market. And then after that, I just felt like, the prices continue to rise. A lot of the properties are a little overvalued, and then combine that with really high interest rates nowadays, is just tougher to find good deals. Still possible, just not as many as probably 5 years ago. So we focused a lot more on operation improvements, kind of efficiency, working to minimize our vacancies, improving those rents, because I think once you have 10, 20 plus units, there's a lot to be said for actual operational improvements that you can make that'll have a significant, double digit percentage improvements to your cash flow and profit, as opposed to just saying, hey, I just want more and more units. A lot of times it makes sense to focus on what you already have and make smaller, incremental improvements that would kind of pay dividends long term.
Yeah, it makes perfect sense.
Long-winded answer. Sorry.
No, that's perfect. That's great that you got into everything. One question I had is, because you are doing this part-time, and I think, when people say passive investing and they're actively buying real estate, I feel that's kind of like silly. It's as best as I feel like you have it is a semi-passive type setup, and which I love. It's great, and that's when I've had small portfolios of properties in different areas that were managed by a property management company. Can you tell us a little bit about kind of how you're overseeing your current real estate portfolio? Like, what is kind of your team look like on the ground? You went into some of the different contractors that you have and stuff like this, but obviously you're not the middleman on a lot of this between different parties. So tell us a little bit about that, because that is something that's difficult, I think, for some real estate investors as they're growing their portfolio to be able to put their people together, you know what I mean? And have them issues. And then you kind of like get an email or a text afterwards saying that, hey, we changed out this hot water here that was leaking, and you didn't have to go all these different people back and forth on the phone.
Right. So to me, again, real estate, throughout our investing journey, I had, my career first, then my own business, my own company that I run now. So that has always been my kind of full-time occupation, as opposed to real estate, because real estate for us has been more of an investment vehicle, not a job, and not to say that you can't make real estate kind of your full-time gig. I just always, suggest you look realistically at where you can make pretty much the most money for your hour, for your own time, right? So if it is real estate, maybe you get into flipping, for example, to help you generate some of that capital and then invest that into rental properties. I've met people that do that with great success. For me, it was more, hey, I can make better use of my time if I work on my own software company, if I work on my career, and then take the money that I make there and invest it in real estate. So that's kind of where our head's at, what made more sense for us. So from the get-go, I knew that I didn't want to spend time specifically on property management, because I think that's probably the most time-consuming, other than like deal acquisition. That's the most time-consuming part, and it's actually not a very good paying, part, because if you look at how much property managers actually make, it's typically 8 to 10% of rental income. And if you actually look, at a property that's, I don't know, making $1,000 of rent a month, we're talking like, $80 to $100 that they make a month. It's not a lot of money. They're able to scale because they have 100, 200 units. But for you to self-manage, unless you kind of really want to do it, or you have a small scale local portfolio, I think maybe it makes sense. For us, it didn't. It was out of state. It was a lot of units, and I wasn't going to be, like you said, fixing toilets, managing tenants. So I would say the key, to answer your question, how best to approach it. Obviously, you need to build kind of that initial team. I would say the two biggest individuals or companies that you should find are, first is a realtor or a broker, so a person who can help you buy the properties, and you want a very knowledgeable, kind of, honest, good communication person, or a team of kind of agents that can actually guide you through the market, especially if you're not familiar with the market, answer your questions, very forthcoming, kind of the basics of what you want to work with. I always recommend getting referrals from other investors as opposed to just Googling or finding kind of a blind company. So actually, network maybe on Bigger Pockets locally in your local real estate groups. Find those people, see who they use, who they recommend, fly out or go drive, meet this person, have a little informal talk, lunch, whatever, coffee with them, explain where you want to be, make sure that your kind of goals and your situations align. Because for example, if it's an agent that doesn't really work with investors much, they mostly represent homeowners, they're not going to be familiar with, if you say, hey, I want a cash on cash return of X, I want cap rate of B, that they just maybe cursorily familiar with those terms, but that's not their forte. So find an agent broker that's actually specializes it. When it comes to property managers, I would say probably out of, 5 property management companies, like there's probably 3 good ones. Like that's kind of the ratio I've seen. Unfortunately, there's a lot of property managers, and a few of them, maybe half, are just not, not that good. They tend to, I feel like, be larger, more like national companies, multi-state companies. They may have hundreds of units per each individual person. They just don't spend a lot of time on each unit, on each property owner, so that you kind of can get put on the back burner and neglected a little bit. I personally prefer a little smaller local companies, so maybe that operate within a specific city, and also that operate within your specific asset class. So for us, for example, in Kansas City, this was multifamily. When I was looking for property managers, A, I got referrals from other investors, friends that I knew in that market. B, I specifically looked for multifamily managers because that was the property class that we were buying. And C, I was very, I had a list of very specific questions based on our investment strategy. For example, I knew that we were going to be buying value add properties that needed some work, needed some rehab work. So I wanted to find a property manager that can also be a project manager or a general contractor, if you will, or even if they had their own maintenance and rehab crew, which we ended up actually finding that they can do in-house. Not every property manager can do that. Some will straight up say, no, I don't manage rehabs. I don't even get into that. You'll have to find your own contractors. So if you go that route, you have to be realistic. Well, you'll be on the hook for managing rehabs, or you need to find a third person like a general contractor to do that for you. For us, eventually we were able to find a property manager and kind of actually work with them a little bit to hire a few more people on their team, to kind of fit the model that we were doing, which is, again, buying, a little dated, somewhat distressed properties, rehabbing them, fixing them up. Nowadays, we basically have essentially our own, contracting teams, our own rehab crews that our property manager has for us and their other clients, that know exactly what we want, know the fixtures, know the costs, know, which aisle at Home Depot we buy our tile and flooring and all of that stuff. So the process is very ironed out. Obviously, at the beginning, you'll have to kind of work with the property manager. And I would tell kind of every prospective owner not to be afraid to get a little more involved, especially in the first year or two of operation, especially if you're doing rehabs, kind of not micromanage, but check a lot of stuff. Like look over the, the costs, look over the analysis, look over what materials they're using, where they're buying, and ask them to make changes as necessary, because it needs to be kind of a dual relationship, not just them doing stuff how they see fit, and also not you just telling them like, hey, here's exactly how I want stuff to do. It's more like, I would say, a mutual thing where you give some input on how you want things done. They have some processes that they already have that they obviously use for your properties, maybe with some modifications based when you tell them. So initial work kind of took a little bit of time. Again, I flew out there a few times. We would actually go to a unit with our property manager, with our rehab guys. We would say, hey, this is kind of the checklist of how I would approach this rehab, the items I would replace. We would go over the budget. And then over time, I didn't have to do this every time, right? Because we had a standard checklist. We had, same for like leasing, we had a standard set of guidelines that I always wanted them to use for leasing. They knew kind of, where I stood on pets or smoking or whatever the little nuances. And then over time, they just used them. And another thing that I would do, and I still do, would be regular checkup calls. And I think this is essential, especially for large portfolios. If you have a property manager with 5, 10 plus units, call them every month. Just say, hey, if you guys don't mind, which they should not mind, if they push back on this, I would say it's a red flag. Saying, hey, let's do a phone call every month, beginning of the month, whatever, for first Monday or something like that. Let's put on the calendar, and just get on the phone with your actual property manager or whoever is overseeing your portfolio. Run through your checklist. Say, hey, how are the vacancies going? Are we having issues with renting the units? Are they sitting on the market? Maybe we should adjust our target rent a little bit. How is the maintenance going? Rehabs? Just kind of run through them, make sure that everything is going smoothly, because I think for a large portfolio, you need to treat yourself as basically the CEO. Whether you've ever been a CEO or not, you are now in charge. You have multiple units, you have multiple people managing, working at, overseeing the units, and you as the owner, you're essentially the CEO. a good CEO does not go and do the job of each individual person, because you hired them to do that job. So a good CEO doesn't micromanage, but a good CEO kind of looks at the trends, kind of the overall picture, and if there's any inefficiencies, any kind of bigger systemic issues going on in this area, maybe leasing or maintenance or maybe advertising, you shouldn't be afraid to step in, kind of dig into a little bit, understand what the issue is, and kind of brainstorm solutions for improving that, then communicate that to your property manager, and then from there hopefully kind of gets back on track, but then you monitor that as the months go on. So I think if you can establish like a mutual kind of trust relationship, but also a good working relationship where you're able to provide feedback to your property managers and other members of your team. I think it'll be a little bit of work up front for the first few years, but then nowadays I can probably talk to our property manager a few times a year on our existing properties. I don't even have to do the regular monthly phone call because I know that they're super on board and kind of on the same page as far as what I want done and how I want things done.
Yeah, that's great. That's a lot of great information for someone that wanted to set up a portfolio themselves of buying properties and really step back from the day to day and have a team that's able to handle that, which is one of the things that I think scares most people away from becoming real estate investors, because they don't know if they want to get to that as soon as possible, but like you already have a little bit of scale of units, which makes it much easier to get there. So if you had all these requirements and you had a fourplex, they might not, that property manager might not feel that they have enough, making enough from this relationship to do that. Whereas now you have 40 units, it's now they're getting a sizable monthly check from you for helping you and keeping you happy and keeping you as a client long-term.
Yeah, no, that's a good point. And again, obviously you have more leverage as your portfolio grows, right? Like you said, 4 units versus 40 units is a big difference for a property manager in terms of income. So I would say, if you do find a good property manager, if you vet them, get good referrals, they have a good reputation among real estate investors, you probably will be pretty good even off the bat. Even if you just kind of said, you know what, you guys just do what you typically do. I'm not going to go in there and give you very specific requirements. And that's not kind of I'm advocating either, right? A good property manager should have a lot of different processes in place. So I think a lot can be said for doing that initial selection, kind of interviewing, vetting the property managers, not just picking the first one you come across on or the cheapest one, even. So if you do a good job vetting, I think probably 9 times out of 10 or something like that, you would be just fine. To get go, you might have to do some things yourself, like maybe contract management, right? If contractor management, if that's not what your property manager does. And then as your portfolio grows, I would definitely kind of, make sure that you communicate with your property manager if there's some problems or some changes that you want to implement.
Yeah, that's a lot of great information. The best property management companies and or contractors I found is all through referrals, not from brokers, from other similar landlords in that area. And finding,
I 100%.
Yeah, it's like you'll get stuff from brokers, and stuff like it's from brokers. Even I hate to but it's just like you're not getting a lot of some of the stuff you just get. And you're like, they'll send you. I'll get somebody and you're just like, no, this is, or this just doesn't fit what I'm doing, and they haven't used them much before. And getting referrals from people in the trenches, quote unquote, is really it speaks volumes about what you're getting. And also finding, like you said, local property managers. Completely, I double down on that. Like if there is as entrenched for decades in that market, you know what I mean? And they know the rent,
they would know the area as well. Correct.
They know everybody in the town hall, first name basis. They have it on their phone. All this stuff, and it's this is what you're paying for. You're not just paying for them to collect rent and to call their handyman to fix the faucet or whatever. I mean, you're paying them also for their knowledge in the area, saying rents are at 1,000. Can we go to 1035? No, we can go to 1020. That's where we are. Okay, so then I know, and that's what I'm paying for. I don't want you to like say, yeah, we'll go to 1035, and then I can't rent it for 2 months. You know what I mean? And you're like, well, if you just told me what I should have done initially, Or is this a good price on roofs? Because they're dealing with roofers all day long. So if you have a third-party roofer that comes in, obviously they're not going to have their own roofing company most of the time. And you're like, what is this? Like, yes, a similar property 2 miles away from you. This is, you know what I mean? And then you're like, okay, so now it helps you save a lot of time because you're bouncing it off someone that actually has knowledge. Social media is great, but you're bouncing a price off something and someone's responding from 4 states away that maybe doesn't own any property, compared to someone that's integrated into the area and knows exactly all the players and contractors to deal with. So long-winded on my end, but that's kind of the praises of what you're saying about property management, because it is what keeps everything together and makes everything run smooth.
Yeah, no, I couldn't agree more. And I would just add something I kind of mentioned earlier is there is a big difference between a property manager who manages single family homes and kind of A-class neighborhoods versus a property manager who mostly manages 200 unit apartment complexes. So I would make sure that you're matching property managers, agents, brokers, but especially property managers that kind of fit, what the asset type, the building type, the property type, even maybe the neighborhoods that you're investing in. So if you want to buy fourplexes and up or 10 unit complexes, find a property manager that has a bunch of them, or maybe that's their specialty. Any property manager probably tell you, oh yes, we'll manage your 10 unit apartment complex. But if this is the first 10 unit apartment complex they've ever managed, I guarantee you there's going to be some learning on their end, some little friction and hiccups, because there's little nuances that are maybe not evident to them or to you at the beginning. So, match yourself to the actual property manager in terms of the properties, where they're located, the types of tenants that they're familiar with. You'll just be better off, because you're probably paying about the same amount. That their rates are very similar, but find one, like Charles said, also that has the expertise that was referred to you, that kind of really matches what you're trying to do as well.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. One last thing on your portfolio before we kind of get into your software quickly and then close up here. And you mentioned it that you started investing through turnkey. Turnkey is something I've never done, but you touched on it quickly, and seems like you went off and started building your own portfolio. Can you tell us, like really what your experience was with turnkey, what was good, what was bad, and because there's investors that probably find that to be the easiest path to building a portfolio themselves.
Yeah, so turnkeys, they do get a bad rap. And I would say there's definitely a lot of dishonest or maybe less than honest, turnkey companies or providers. To me, turnkeys was always just a different acquisition strategy, right? And that's all. Like, it's not a magic, like, hey, you get a great property for no work. If you think it's akin to buying like an index fund or something like that, meaning you buy it, forget about it, it's growing for you, you're going to be disappointed. If you kind of look at it as just, a little bit different way to acquire properties as opposed to normally. So normally, you would find a market, have to build a local team, presumably, right? Agents, property managers, find properties in that market, maybe distressed, maybe off market, buy them, rehab them, rent them out. And then you're, the property owner, and you go into the management phase, right? Turnkey properties takes a little bit, saves you a few of the steps. Presumably a company is in the local market, they're finding all the properties, they're rehabbing them, and then they're selling them to the investor sometimes already with the tenant in place. So you're kind of skipping the part where you have to build a big local team. You're skipping the part where you have to source your own deals, off market or distress, you're also skipping the rehab part. The rest of the process kind of still applies. Basically, is every area or market where turnkey properties are going to be advertised or sold at a good area to own long-term rental properties? No. In fact, probably most are not. So you still need to research the market. You still need to research the neighborhood where the property is. Is the rehab that the company performs going to be absolutely 100%? You'll never have to fix anything in 10 years? No. They do some form of rehab. But you're still going to be responsible. Stuff's still going to break from then on. So I think the keys, with being successful with turnkey companies, and my personal experience has been good. Like they're probably not the best deals we've ever bought, but we still own a few turnkey properties that we bought 10 years ago. They're doing great. They're appreciating. The rents are growing. They have good tenants in place. Looking back, does it really matter if I bought them through a turnkey company or myself? I probably missed out on a little bit of kind of initial equity, meaning a turnkey property will be probably sold at market value. So you're not going to get any discount. Looking back, maybe I bought a property for $100,000 from a turnkey provider. I probably could have bought it for and rehab maybe for 85, 90,000. So I would have had a little bit more initial equity. But once you own the property long term, the operating period, the actual rental period is what matters. So it honestly does not. It doesn't become as important how the property was acquired. What is important still, whether you're buying a turnkey or not, is that you research the city, the market, the neighborhood where the property was purchased. It's a good growing kind of area where prices are appreciating, values are appreciating. Which it happened in our case because I did do that research on the markets, on the neighborhoods, instead of just blindly going to the turnkey website, finding the property with like the highest returns, I don't know, sorting them by cash on cash return or whatever by the cash flow. I think that's the worst thing you can do is if you just approach, buying turnkey properties across different markets akin to like purchasing stocks or something. You're just looking for the best performer. You don't even care what industry they're in. You don't care who's managing it. Same with turnkey properties. I've seen some investors, they will just get a giant spreadsheet from a provider, properties in different cities, different states. They don't even look at that. They'll sort it by cash flow and say, you know what, I'm going to buy the top two or one. That's setting yourself up for failure because A, you don't know where the property is located. You don't know what's going on with the market. A lot of times the turnkey properties will kind of skip over all of that. They'll just focus on the numbers because that's what sells, to the end buyer, which is you, the investor. But if you research all of that, and then again, vet the turnkey provider, obviously, because again, some of them will kind of do subpar rehabs, try to hide major issues. Look at their reviews online. Sometimes you can find it, some forums like Bigger Pockets, or ask them, hey, can you send me some contact info of other investors who have used you, preferably the ones that have owned the properties for 5+ years, because that's when the big problems start to appear, is not initially. Initially, everything's probably going to be good, but then later on. And then also vet the property manager. If the property is already rented and there's management in place, do the same vetting you would do for a property management company that you would do normally, but for this property management company, that's basically you're going to get, because you buy the property. And again, it could be related to the turnkey provider. It could be just some random company they used. But if the property management company, you start looking into this, it's raising some red flags, not good reviews, can't find anybody who ever was happy with them as an investor, like that's another red flag, So I guess bottom line is I would just approach turnkey properties as kind of another acquisition channel. You have your MLS, like you're looking on listing websites. That's one way you can work with wholesalers or other off-market channels, or you can work with turnkey providers. It saves you a little bit of time. It costs you a little bit of extra money because you're not going to get a discount on the property value. It could be a good way to purchase and acquire, especially out-of-state rental properties. But I think if you're skipping that initial research into the market, into the actual companies that you're working with, and if you're kind of thinking that, hey, you know what, they've done all the due diligence and I don't have to do anything to save me time, I think you might be in for a little bit disappointment and some problems down the road, because again, there's some markets and providers that are just not good. And if you don't kind of focus on that, because once you buy the property, you're the owner. The turnkey provider pretty much has nothing to do with it. There might be some, I don't know, guarantees or something that they have in the contract, but ultimately you're the owner. You have this property, you're responsible for it. So from that day, it doesn't matter how you acquired the property, all the same kind of, management and other decisions that they still apply. So that's my not so short answer on that.
No, that's great. That's a lot of great information. I have a lot of listeners that have messaged us before asking about turnkey. I've never invested. I'm not a turnkey investor, so it's one of those things I don't have any information for them to help them. So that's a lot of great information that I can point them to. As we're kind of wrapping up here, you founded those two real estate software platforms, DealCheck and RentCast. Can you explain, what they do, why you founded these platforms, and how they've assisted you in becoming a better real estate investor?
So I know we're kind of running a little long, so I'll mention them really briefly. And then if you guys have more questions, you're always welcome to go to our websites and check them out. So the two platforms that we own is, the first one is DealCheck. It's been around for almost 10 years. That's focused on property analysis. So obviously a key part in buying properties is, they say you make your money in real estate when you buy, which really means you have to research the property, the cash flow projections, or your profit projections for flips, for example, to make sure it's going to be a good deal long-term, actually make you money, improve your financial situation and not be a burden, because otherwise, why are we buying this investment property? So DealCheck is an all-around platform that assists investors with analyzing rental properties, flips, BRRRRs, rehab projects, wholesale deals, multifamily properties, a very wide range of real estate investments. And we'll walk you through the whole process of helping you, understand what your purchase costs, rehab costs will be, what your cash flow will look like, as well as what your long-term projections are going to be in the future to see, so you can plan your exit strategies and how much profit you will actually make from the deal. So you can try DealCheck for free at dealcheck.io, or you can download the DealCheck iOS or Android app on your mobile device. Either ways, it's a great platform. We have hundreds of thousands of users using it. And then our second platform that's a little bit newer is specifically geared towards landlords and rental property owners. It's called RentCast. Again, you can start with it for free at rentcast.io. And RentCast helps you first analyze rental markets. So if you would like to see hey, where the rental projections in the market, are the rents going up or down, stagnant? Again, I think it's very important for a good rental market to be appreciating both in values as in rents. We have a whole market analysis tools in there. And you can also analyze and track rental rates for individual properties. That's a key component of those cash flow projections, because if you overestimate how much a property will collect in rent, that affects your whole bottom line. So RentCast, you can look up rent estimates, rental comps for any property, as well as track your portfolio, so you can see how your rents have progressed versus what you're charging, to see, hey, maybe it's time to bump up the rents a little bit. So rentcast.io, again, both are, you can start using them for free. There's very nominal upgrade fees if you'd like the full feature plans. But we have, hundreds of thousands of users using them. And I use them myself personally, both DealCheck and RentCast, for all property analysis, all deal acquisitions, because I just think that's such a crucial part of the real estate investment, cycle, is to make sure that you're actually going to get a profitable investment before signing that contract.
That's a lot of great information there. Is there anything else that you want to leave with our listeners with, other than those two websites, which we will put into the show notes?
Sure, Charles. I'll say my best piece of advice that I always give, regardless of what you're doing, but especially with real estate, is don't be afraid to start small. It's very easy to listen to an interview with myself, with other guests that you guys have on the show, saying, hey, I have 40 units. Some people have 200 units. I'm buying these huge apartment complexes. We didn't start that way. And it's, if anybody tells you that, they're maybe exaggerating, maybe lying a little bit, or maybe they got lucky. But I think most investors start small, start with your first deal. It could be even the house that you personally live in and then decide to rent out. I think that's a great way to start in real estate. Maybe you house hack a duplex like me and my wife did, and then move on to multifamily properties. As we touched on at the beginning of the podcast, real estate is a very hands-on practical, I think, endeavor and task. It's very hard to learn everything from books or podcasts or articles online. But once you do that first deal, maybe it's not going to be your best deal. Actually, it probably won't be. You'll probably make mistakes, but you learn a ton. And kind of every deal you do from then on, like Charles said, his second house was much better than his first. I can relate to that. We've incrementally improved probably on every deal and every property that we've purchased because you learn so much along the way. So don't be afraid to start small. Buy that first property, buy your own home. Even if you're currently renting, buy a little duplex to house hack, see how that goes, and then let kind of the natural progression take hold. And over time, before you know it, in 10 years, you might have 40, 50, you might have 200 units. And then kind of you look back and be doing this podcast with Charles and telling other people to not be afraid to start small, right?
Exactly. That's the plan. A lot of great information there. And the other thing too is that, when you're starting small, real estate's really a buy and kind of wait investment strategy versus other ones. When the wealth is made and you hear these stories, it's people that bought, they had an inkling, they had an idea about the area, the property, whatever it is. And then they looked at their property price, decade plus down the road, and they go, wow, this is what happened to it, because you're not something that you can easily keep the track of. So
right.
Thank you so much for coming on today. A lot of great information. Listeners, thank you so much for listening to this episode. We'll put all the links into the show notes, and looking forward to connecting with you here in the near future, Anton.
Definitely, Charles. Thank you for having me.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.